Good afternoon. For those of you joining us for the first time, I'm Roy Weiler, Director of Trading Operations for Time Leverage Capital. Welcome to our Combining Futures and Options to Cap Risk webinar. For anyone who missed our previous webinars, give us a call at 800-519-9085 and we can send the videos you missed. First things first, please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Please be sure to read all disclosures before investing. If at any time during the webinar you have questions or trade ideas, type them into the chat box and we'll do our best to answer them. Also on the line today is our presenter, Mr. Adrian Mueller. He's the founder and principal of Time Leverage Capital, who was the chief strategist of Dow Jones Megatrends and All Markets newsletter and lead developer of the Option Ranger software. Mr. Mueller?
Thank you, Roy, and good afternoon, everybody. We have some very exciting days in the markets today. We're seeing a pullback in bonds on Yellen's speech. The S&P has rallied back above 1,800 after that very short-lived correction, and we are seeing some possible breakouts in soybeans, as well as crude flirting, March crude flirting with the $100 a barrel mark. So before we go any further, I'd like to let you know that the examples which we will be reviewing today are not intended to be trading advice or individual recommendations. The Option Ranger is an educational tool in order to model out and simulate trades and hypothetically look at different values at expiration and intrinsic value. So please be sure to log on to the Option Ranger, get your own unique username and password, and then you'll be able to see all the details. Today's session is the latest in the series on doing calculations on the Option Ranger. If you would like to go back to the basics, in addition to logging on, I recommend that you go to our reference section, the reference materials, where you're going to find option sheets with definitions and review. You will see some demo videos on how to input trades. We have demo videos on the basics, or what I would refer to as the foundation of option trading, as well as links to margin rates and so on. If you would like to see more extensive presentations of the basics of options, buying calls or buying puts, writing calls or writing puts, the four pillars of option trading, please be sure to request access to our webinars which discuss those trades in greater detail. Again, these are not individual trade recommendations. These are ways of analyzing trade ideas, and then you have to make sure that based on the risk and reward, these types of trades are suitable for you and your financial objectives. Today, because crude, as I had indicated before, is near the $100 level and actually exceeded it, and by request of a few of our clients and beta users, we are going to be doing some examples on shorting crude. Again, I'm not saying crude oil is going down, but these are examples of the different ways to approach that market should you believe that the market is going down, and we will show how with the Option Ranger we can compare and assess different levels of risk. So let's get right to it. We've already saved these trades on a tab, and if you want to learn how to input these trades or have your own trades saved for you, be sure to let us know. First and foremost, let's begin with the most obvious, and again, we are using the May contract here. As you can see, these are hypothetical trades. So the first one, just to look at the basic risk and reward based on leverage, is shorting one crude oil contract at 98.50. This would be basis the May, and actually was there earlier. Right now it's at 98.61. Again, this is just an illustration. And as you can see, once we select the trade, all fields are populated along with your individual values. If you want to get, remember, if you want to get more information on crude, all these dialog boxes keep popping up when you select the contract. So if you select complete contract specs before looking at crude, you will see that we are going to get a complete description of the contract, the symbol, where the contract size, trading hours, limits, and so on. We'll get a short-term chart here. This is a crude oil chart for March. And on the right, this is something that was devised over a number of years while writing the Megatrends report for Dow Jones, in which we made a selection of all of the things to watch in order to both decide whether or not to trade crude oil, and also while in the market, the key events and reports that should be monitored in order to decide how you want to continue with your position, if you want to offset, or if you want to adjust in any way. Now, let's go back to our calculators and look at the first trade. When you select this trade, you can also go into our strategy gallery as a reminder where you will see the different ways that you can use your directional and volatility outlook to select a trade. If you have a bearish outlook, as you would in shorting of futures, and an unknown volatility outlook, then you would look at a short futures, which is our present trade. So let's go ahead and back to our example. And as you can see, we have the contract size listed here, and we immediately get a spreadsheet on this particular trade. You're selling one crude oil contract at 98.5. There's no premium paid or received, so that the premium column is 0. When you buy or you write an option, this premium column will have a value. If you paid for the option, then you would have a minus, which is what you paid for the option, and if you collected premium by writing an option, you would have a positive value. Again, in this case, there is no value because in futures trading, there is no premium. Gains and losses are tick for tick, net of commissions, and of course, in this particular case, we have a default transaction cost that we input, because whenever you do math on a trade, on your profit and loss, you should always factor in your costs. We have a default cost in here of $45 around turn. Your costs may vary. Immediately, as you can see, we have a break-even on futures. We have a risk parameter, which in this particular case, as you notice, we put it in red, is unlimited, $10 per tick, about 98.46, and in addition, we have a review of the contract size, and then a very simple spreadsheet in which you see the gains if the market goes down, tick for tick, at different values. Obviously, on a large drop is very good. You see where your break-even is, and then, of course, then you see the reason why some people are reluctant to trade futures outright, because as a net margin trade, as you can see, on a move to 110, this trade, if you don't offset, if you don't get out of it, you would be down 11,545 and so on. $10 per tick going up. So being short futures, if you're bearish crude oil, is indeed a bearish idea and has a pretty significant amount of potential on a drop. The first thing that you would know with the option ranger is to look at this range of risk and decide whether or not there's, under any scenario, the potential for a large upside move that would hurt your position. And if you are unable to take that kind of risk or incur that kind of a loss, then this software should have served this purpose by showing you that this is a trade for somebody who cannot tolerate that type of risk. It's a trade to avoid. Now, just for purposes of comparison, because you should know all of the tools and contracts that are at your disposal, you should be aware that there's also an E-mini contract. So when you input your trade, if you think some of those numbers are kind of difficult to tolerate, you can say, well, let me see how that works. If I do a mini contract, which is a smaller contract means that you make less if it goes your way, but you also lose less if it goes against you. So here's a person still taking the margin risk. We still have our premium levels of break-even. As you can see here, on a drop, the numbers are significantly smaller as to gains, but on the other hand, on a rally, on a risk-to-reward basis, the numbers are also smaller as it goes against you. So although it's an unlimited risk for tick going up, because the leverage is less, your risk is less. One of the main things you have to know in trading is that there is very powerful leverage at work in some of these markets, and you have to know whether that leverage will work for you or against you, and under what circumstances you can choose to take direction with margin, or if you do not have the risk tolerance or the desire for it, without margin or with some sort of a spread. So now, as you can see, one way of mitigating risk for somebody who thinks crude oil is going to drop, and again, that is a directional opinion. We're not in the direction business. We're in the modeling business, if you will. As you can see, this smaller contract make it more tolerable for somebody, although there is an unlimited margin risk to the upside. Some people are just flat out not going to want to be short of futures, whether it's a large or a small contract. I know some people who will say, I will never be short crude oil and risk a margin call, because what if something happens in the Middle East? They shut the Straits of Hormuz, or there's some kind of major disaster, perhaps sabotage of Saudi oil fields and so on, some kind of Shia-Sunni dispute that would make this market fly to the moon. And that could be a pretty bad event. So I know some people who are very shy, understandably, of being net short crude oil in any sort of margin way. Now, so somebody like that might turn around and say, well, I don't really want to be net short crude oil. Let me see what it would be for me to buy an at-the-money option. And that would be, we're looking at a May put at 98.5. So we're going to pull that up. And this is on the large contract. There are only puts on the large contract. And now we see a very significant difference here. We've got the tick values. It's 1,000 barrels. But as you can see, this particular transactions cost 2.1 premium points. At 1,000 barrels per contract, that's 2.1 times 1,000 is 2,100. So this option would be a debit or a cost of $2,100. This person is paying a premium to have the right, but not the obligation, to be short crude. So a person like this would not need to be afraid if crude oil goes to $150 overnight. They can rest assured that their maximum loss would be the premium that they paid plus the transaction costs. You always have to figure out on the cost of doing business, so it's $21.45, and they still have a profit potential. However, their premium break-even is now at $2.14, and their futures break-even is $96.36. So they need a larger drop when they buy this put to break even, because they have to overcome this $21.45 before they can be in profits. And that can be done either on premium or intrinsically on the futures price. In addition to limiting the risk on this trade to the premium plus costs, it does have an unlimited profit potential. However, bear in mind that that profit can only be realized when the costs are overcome. So this person is trading off the pain of unlimited risk for needing a larger move to make money and for having to pay some premium out of pocket instead of trading tick for tick. And now we see the big difference, however. In this particular scenario, on a move to 110, the loss, although nothing to be happy about, is the entire premium paid. And as you can see, and we can expand these rows as far as we want, whether the price goes to 106 or 110 or 150, this is the maximum risk, as you can see, because you can't lose more than the premium paid, and this person would have no interest in exercising an option. They would just let it go. Parenthetically, options trade. So if you see that your objective is not being met, if you don't see the market going in your favor, options have time value, they have premium value, which you have to keep monitoring. So what you can do is you can set up a platform with us, or if you're trading in real time or working with a broker, you can get premium quotes at all times to know whether or not your premium, that is the quoted value of the option, is exceeding your break-even point, and whether you are in gains and want to take a profit, or you are incurring losses and have decided that your outlook is incorrect. It is usually wise to monitor these prices and come out. So let's say if you spent $2,145 on this option and it increases on volatility to 3,000 or 4,000, you don't have to wait for expiration. You don't have to wait for all these intrinsic numbers. Just get a quote, and if the quote is sufficiently above your premium, offset the trade. You can do it any time. By the same token, and this is very difficult for many people to do, let's say you're in this trade, you think crude oil is going to go down with rising volatility, which is what you need when you buy a put. You need a drop with rising volatility. You can see that in our strategy gallery and in our previous examples on buying puts or being long premium. If the put does not appreciate, if the market doesn't drop hard with rising volatility and you don't see your values go up, I believe, in my experience, that in most cases it is foolish to sit around and wait to incur the maximum loss of $2,145. Perhaps if this option is down to $1,500 or $1,200, or sufficient time has passed, or your outlook has changed, you can offset the option, salvage as much premium as the market will allow at that time, and move on to greener pastures, because time erosion and the handicap of the premium will go against you. So this is a trade for rising volatility, but monitor your values if necessary to come out early. I tend to use either a 50% alert, so that if a premium gets down to half, I look at it very closely and decide to offset. If it's an expensive option, you can use a higher percentage. You can also use a time stop. So if this is a May option and it doesn't do what you want within a certain period of time, you might say, if this thing doesn't drop and become profitable for me by the 3rd week of March, again, it's just a hypothetical, then you should have a discipline in place to offset. It's very important to think about these things in advance. As you know, he who fails to plan plans to fail. And planning is not just about getting into a position, it's about getting out. Also, frankly, especially when people are losing, they tend to cross their fingers and hold on to options, and they could continue to erode further in time. So then I would give you one of my other favorite quotes, which is, "He who fights and runs away lives to fight another day." And certainly letting that much premium go to zero on an option over that period of time would require a lot of sitting around and finger crossing. Now let's go to one of our combination trades, again, to see how many different ways there are to be in this market. So far we've looked at the full-size futures contract. And let's go back to where the ranges are and the risks. You see big potential profit, pretty decent profit even on a small drop because there's no premium paid. And then, of course, unlimited risk to the upside, which can become pretty significant. And as you can see, when you compare the losses on the futures versus the losses on the long put, on the move to 110, you can see why some people will pay that premium and accept the handicap in order to reduce their risk. One way of combining premium and the instrument is simply to use a spread, and our option calculator is suited for creating all kinds of spreads, as you can see in our strategy gallery. And here we are talking about the possibility of doing a strategy called a covered put. Some of you may be familiar with a covered call. This is a covered put. And again, this is a strategy in which you would be short the contract, an underlying instrument. So you're short at 98.5, which is the price that we discussed. As indicated, there would be no premium on that because it's a futures. Your only cost there is your fees for placing the transaction, but there's no premium paid or received. And then, however, there would be, in addition to give, in this case, a margin of error, somebody might sell a put at 94. In this particular scenario, the person is capping their profitability between from 98.5 to 94. And of course, they have to factor in the money that they collected for the 94 put. You can look at a complicated graph from the exchange. You know, they kind of look like this to figure out one of those trades, and they've been put out for many years. But what we try to do instead is we try to actually use the numbers and see if they make any more sense. And again, now we have a futures, no premium. However, when you sell the one crude oil option, it's 1.4, that's $1,400, $1.40 times 1,000 is $1,400. All the math is done for you here, which means that when you put on this trade, you collect $1,400 for the option. There's no premium for the futures. You take out your transaction costs. Again, it's just a default that we use. Your costs may differ. And in this case, the minute this person puts on the trade, they actually collect $1,310. And they have a transaction that's going to look like this. Now again, let's take the plus and the minus. On the downside, as I indicated, by selling that 94.5 put, you're capping your gains to 58.10. Because anything that happens under that strike price that you sold, you no longer get to make. And we can have a greater discussion about spreads later, but as you can see here, you can actually look at the numbers and model them out. The problem, again, with this trade is that although you are getting a bit of a credit in the beginning, and have a closer break-even on the futures. In fact, because you collected that amount of money, if the market actually goes up, look at your break-evens. If the market goes from 98.5 to 99 by expiration, instead of losing money, you actually make more money on the put you sold than you lose on your futures. Even at 99.5, which would be $1 up from the entry price, there's still a nice little gain of 310 based on the intrinsic values if that other option expires worthless. And unlike a net short futures at 100, instead of being down $1,500 plus costs, you would only be down 190. So a trade like this improves your sweet spot at the market, maybe at a flat market, a tiny rally, or even in a drop. The trade-off is that on a very large drop, below that 94 level, you have capped your gains, and as you can see, it doesn't matter if crude oil goes to zero, you can't make more than 58.10. This is a better trade for a more narrow market, for a small drop, for a small rally. But if you have an iota of a notion that this market could explode to the upside with the rising volatility, the option ranger automatically gives you a very powerful reminder of just how much you can lose if the market goes against you. One of the most important things in modeling trades and looking at trades and in evaluating decisions is not so much the trades that you end up picking, but the trades that you end up avoiding because wishful thinking can get in the way of logical decision making. And a nice spreadsheet like this is going to put the facts in front of us objectively that perhaps we either can't think of or perhaps don't want to think of because we're enamored of an idea, or we hear some analyst say something looks really good. Now, along those lines, I was thinking of coming up with some sort of a bearish trade that would be less costly and be in line with an outlook to say, well, this market could drop, but it's not going to drop past a certain point. So using some third-party analysts, we came up with shorting, with buying an at-the-money put, which is a 98.5 put right at the money. This is for May. And just for purposes of checking out the market, for one who thinks it's not going to drop horribly, but may think it could rally like crazy, this is a trade in which you sell multiple puts against a one long put. So it is a margin trade. Now let's see how it looks. It buys a 98.50 put at 210, sells 3, in this case, puts at 90 for a premium of 65 or $650. Again, the multiples are right here. So let's say, for instance, if we look at the, just a moment, looking at the crude oil here, it's 2,100 is the amount paid for the long option. 1950 is collected for the short option. So that trade is actually an out-of-pocket cost of 150. And again, you factor in this 3 round turns, 3 commissions at that default price, and the actual out-of-pocket complete cost at that structure would be 290. Only 290. Let's look at the break-even point. The low break-even point intrinsically is at 85.90. So as long as this market drops and doesn't go past 85.90 on a drop, you're good. Your high break-even point is 98.21 because if the market goes up, intrinsically you have a debit. And then we also have a calculation on premium. The maximum loss on this trade is actually on a large drop because you have 2 naked puts at 85. So let's have a look at this trade. This trade actually has a bit of a sweet spot if you look at it. It's between 98 and 86. So this is a trade that is bearish but is not anticipating huge rising volatility on a drop. On the upside, because the long option is a put, your risk is limited. So if this market goes to 150 or flies to the moon, the most that you can lose on a rally is your initial debit on this trade. The place where you make money is on a drop, but not a huge drop. So for instance, if your outlook is that this market is going to drop, but not drop more than $10, then on this particular spread, as you can see, for only an initial outlay of 290, if this market finds its way at expiration to 95, 94, 93, 91, 90, and so on, that you have a pretty significant sweet spot here, and that's why we call this the option ranger, because if this was your range and you were looking for this price range, you could keep combining different options and different strike prices until you get to this sweet spot of a trade. Again, because you're writing additional options, you can only do this trade if you're clearly of the mindset that this market, that you don't anticipate an event that would cause prices overnight to have a $15 drop or a $10 drop or a $20 drop. If you do, this trade is not for you because, as you can see, the numbers against the naked options get pretty significant if they go in the money. So, again, if you're in a trade like this, and you need to monitor it very closely, so if the prices start dropping and it looks like the volatility could pick up, you either offset for gains or adjust the trade. You don't wait for the market to actually drop under 86 or 87 before you start making adjustments. The only time these numbers should really become real on the downside or on the upside is if you have gap overnight moves. And again, for people who are looking at these positions, the option ranger is very easy. You say, well, okay, I want to do this trade, but you want to adjust it, and you think, you know what, I'm not so bearish. I want to be a little more careful. All you need to do is highlight the number of positions in one place, change the value to a 2. So now you're buying 1 and selling 2 instead of buying 1, selling 3. You don't have to reset anything. You're assuming everything else is the same. You hit the calculate button. The minute you put on that trade, it appears among your current calculations right here. So let's see how it looks. And okay, now you have a bigger debit. You have a debit of 905 because you didn't sell 3 options and collect 3 pieces of premium. You sold 2 options, so you collected 2 rounds of premium. So your outlay is bigger, which means that on a running market to the upside, you still have a limited risk of 905, so that's okay, but it's more than before when it was 290. Your sweet spot in the middle looks pretty good, and as you can see, your risk on the downside moves over a little bit. So the additional money that you spent by selling 2 options rather than 3 is now translated in the fact that, for instance, 83, instead of being in a loss, you're still in a gain, and even at 82, you're incurring a small loss, and then the loss level on a large drop continues to diminish. So if somebody was bearish and felt the market was going to drop pretty well, but we're still concerned about some kind of an increasing volatility event for some kind of huge unexpected drop, they might opt to spend a little bit more money, risk more on a rally if it goes up, in order to have more breathing room to the downside on this particular trade. Now, as you know, you can take these trades, you can print them out, you can send them to print. So if you want to, and I'm a guy who likes to work with paper, I guess that would make me an old timer as well as a computer guy. You can print this particular worksheet to compare it to others. You can email it to a friend, see what they think about it. You can post it to a forum, either with your own comments or with questions for feedback. Or if you think this trade is worth monitoring or a continuing look, then you save it under a tab. And again, for this particular thing, we're doing short May crude hypotheticals. We save the trade, and then when we look here, we have all this trade has been added to our inventory of other trades that we can compare. So we've got the 98.5, 91 by 3, and now we have a 98.5, 90, 1 by 2. Buying 1, selling 2 here, buying 1, selling 3 here, and then if you want to just whether you print those out or you open to Windows, or you can just click back and forth between the 2. So see the values. Let me look at my 1 by 3. Yeah, I start losing money at 85, but I have a real sweet spot here. But if you're a little scared about the 85 level, you'll say, well, let me see how the other one looks. And see where your profits are, see where your break-evens are. If you're more worried about a big rally than a big drop, then this trade might be one that you can consider if you can afford the margin and it fits within your risk tolerance. And then very quickly, you can go right back to the 1 by 2 and see how that looks different. And again, in this case, on a big rally, this trade seems to look better. It's got a real good sweet spot in the middle here. And again, on this example at 85, it's making decent money, but on a large drop, things start getting severe. So when you look at these different contract values, look at the different markets, you want to make sure that you compare the values, and then be sure to take those values and compare them against real-time quotes You can set up with us if you don't have your own trading platform, you don't have your own trading account. Be sure to contact our customer service desk. You can set up a simulation trading platform alongside with your Option Ranger, and you can input your saved trades there and have them marked to market as you stay in the trade, whether it's for simulation purposes or for updating these values in the Option Ranger. Now, one of the very important things to look at, again, for future reference, if somebody is considering being short this market, and the reason I use this example is because we're getting a lot of inquiries, is that you can be right 5 times out of 10. But when you look at a strategy in these particular terms, and you see the impact of outsized black swan moves, you may adjust your strategies accordingly, because it doesn't help to make $300 5 times in a row on a trade for $1,500 if you're taking the type of risk that on an outsized move you could end up losing 10 or 15 or 20,000. So although you would be getting more little wins on that theory, you still have to be mindful of the black swan or the high risk events, which is really one of my principal reasons for going into the for developing the Option Ranger. Now, in addition to doing these types of strategies, as you can see, we've gone through multiple examples. We've gone through an example of an outright short futures large contract. We've gone through an example of the smaller contract as a short futures alternative. We have shown an example of shorting a futures and selling a put, which is a combination trade, as well as some ratio put spreads. These are positions in which you short a put and you sell, in this case, either 3 puts, and we saw the particular risk to reward scenario on those trades, as well as just for a quick change on the fly, selling a put and buying a put and selling 2 puts. And finally, just as easy for somebody says, you know, I want no risk whatsoever, no margin risk. I think it's going down. I want to collect a little premium, but I don't want that additional downside risk. In case the market breaks down, then you can calculate on a simple put spread. This is a 1-by-1 put spread. There's no ratio involved. Of course, because you're selling fewer options, your initial debit on the trade is higher. If you will, that's kind of a deductible. You're paying more in order to be covered better against risk. So in this case, again, this would be your total outlay, and the good news on the trade would be that you would have a limited risk, which is the cost of the spread, plus your expenses. Your profit potential would be capped, again, because you're selling puts underneath, which cap your profit potential. And then have a look at the table. As you can see, because it's a limited risk trade, crude oil can fly to the moon. It can go to any level. The maximum you're risking is the 1520. That is your initial debit. Your break-even starts slightly under 97 because of the premium that you paid, so that premium has to be overcome. And then your sweet spot begins as you get closer to 90, and your spread becomes fully intrinsic from 98.5 to 90, where you would gain the amount of the spread minus the debit that you paid to be in the trade. When doing these kinds of transactions, modeling these kinds of transactions, we've just seen in half an hour a handful of different ways to be bearish crude oil. Some of them involving significant risk, some of them involving less risk, some of them having margin risk, some of them having spread margin, and some of them having no margin. The important thing in using an instrument like this is to know how much risk you can take, how much reward you think is in a trade, and then be able in black and white to get a fact-based analysis, a fact-based spreadsheet that will give you an objective look at how things will work out on intrinsic value and on premium value during the trade. Are there any questions on any of the items covered so far?
We do have one question.
Sure.
I know the gentleman noticed that there's quite a few strategies inside the calculator already. Are there plans in the future to add additional strategies to the calculator?
The calculator has been designed, and you'll see this in our demo section or in our previous meetings when we discuss the features more. We have, the way this has been designed, and I actually designed this initially as a training tool for brokers. I think many speculators and traders would be horrified, as I was, to realize just how very little many brokers, licensed registered brokers, know about options and risk. So we tried to design a simple instrument where we could save trades and we could compare trades and do the math. The way we work right now on the left-hand side is that you can have any calculation there that is made is automatically saved in the left grid under current calculations, so that you can look at them as you go, and then if you like a particular trade, you can save it as we discussed under a tab, or print it, or email it, or post it to a forum, or you can get rid of it. The custom tabs, and in this particular case we created a custom tab for short May crude hypotheticals, is a tab where we can have multiple items. For instance, we have internally tabs from different directional analysts. I follow FortuneCast. I follow Trends and Futures. We follow Hightower. We follow a number of analysts, some well-known, some not so well-known. And what we do internally is create custom tabs under each person, and then when we expand the tab, we have a look at all their different trades. We also create tabs where we monitor trades internally to see if they get to a particular level, we might take an interest in the market. We can also create custom tabs for Option Ranger subscribers. So for instance, if somebody's a beginner, they're just learning how to input trades, how to demo trades, they want to make sure they don't make any mistakes, they can work with one of our licensed mentors, both in inputting trades in accordance with the demos or in saving tabs. So let's say if somebody's very busy and called us, for argument's sake, and said, I want to be short crude. I'm willing to take margin risk, but I also want to look at some spreads. I think the market's going to drop somewhere between 90 and 85. This is a hypothetical. Then we would either work through inputting these trades with that person, or if it was more time efficient, we would create this tab in advance so that that person can just go ahead and click on all the different trades, look at the risk and reward, evaluate one after the other, see which one makes the most sense, and if any of them make sense, they can go ahead and analyze the trade. The other good thing about having the tabs saved is that once it's all set up like this, it's very easy to change an input. So for instance, if you're buying a put and you want to change the strike price, or you say, you know what, I'm really bearish crude, I think crude is going to just fall out of bed with rising volatility, you know, I want to buy 10 of them. All they have to do again is change that value, hit calculate, and all of the numbers in the field change and populate. So in this particular case, if they bought a 10 lot and the market actually drops to 80, let's say 88, they intrinsically have 83,550. That's very exciting. But because this is an objective item, they also have to know that they would have to have an initial outlay of 21,450 in premium in order to have this opportunity. Again, anybody who's going to do that might even say, well, what am I, crazy? Or they might say, well, I'm going to do it, but if go for a home run, I think the market's going to drop hard, but if these values drop to 15,000 or 12,000 or 10 or some other value, to offset at the market and salvage what they can. So it's very easy once these trades are input. If you, let's say, for instance, for somebody who's a customer of FortureCast or Trends and Futures or any other service, and they want us to model out some futures trades or options trades according to the signals of that service, then it's something that we can easily do. And then we would just customize the tab. So let's say, for instance, if somebody was really interested in looking at grains, to change the example, what we might do is just turn around, and this person is really interested in soybeans. We'll say, well, let's go ahead and set them up a, again, I'm not saying we want to be bullish soybeans, but it's an example. Many, some people are based on a number of fundamentals that we can cover in another webinar, but right now, basically somebody would be able to go in there. Oh, well, might help. The good news is if you don't know how to spell, or you're a really lousy typist, you can go back in and edit, and you can have a version of your own where you can make these changes, or where you can have us administratively make the changes for you and set up the tabs, and then you can say, well, let me play around with some bullish soybean trades, or let me ask somebody to give me some different soybean trades. My outlook is that soybeans are going to go from are going to go to $13.60, but not much higher by May. Let's say somebody has that outlook. We can easily reset the calculator. The person says soybeans. As you can see, you get a drop-down menu when you click on the contract market, so you can just select your market or input it manually. Let's say you think it's going to 1360, so you're going to do, let's say you think it's going to 1360, but no way that this market is going to go above. So then you might say, let's have a look at a spread, which consists of buying calls and selling calls. As you can see, the moment you select the strategy, the appropriate box is open so that you make the right inputs. So because a call spread consists of buying a call and selling a call or multiple calls, the boxes are set up in accordance with your strategy so you don't accidentally select sell or buy in the wrong way. Now let's go ahead and say we've got have a default rate that we're going to buy 1, we're going to sell 2 because the person feels there's a strong cap at 1360. This is a made-up trade. As you can see, whenever you click on something, just the dialog boxes start opening up. How many bushels in a contract? What's the tick value? You can click here to go to news and contract specs. You can go here for an example of for information about strike prices and how to input the trade. So let's say in this particular case, somebody says in May, I think it's going to 1360. Let's say they want to buy a 1320 call, which is fractionally in the money. The market settled at 1320.5. And do we have a value on that call?
It's settled at about 37 cents.
Okay, so we're going to call that 37 cents, nice and juiced up. That's got, and you're going to see this in when you look at our option sheets. You're going to see that if the market's at 1320, and this option is at 37, that means that it's got 37 cents worth of volatility or juice premium, and very little in the money value. Let's say almost none. It's a 1320.5. And let's see, what are the 1360 calls?
They settled at 20.5.
Okay, so we're going to call that 20.5. And again, you have indications here on how to input premium prices. So once you get the quote, and again, if you want to have further information on premium, the dialog box that opens whenever you make the selection will always take you to a learn more or to a help section. So as you learn more and more, you can always go back. We have all these little props and helpful areas and crutches and sheet sections. And now we're going to go ahead and look at this trade. I have no idea if it's going to make any sense. Okay. Oh my goodness. Well, the trade actually is a small credit, even after commissions. And let's see, if the market tanks through the floor and doesn't go up the way you expected, you still get a little $95 perk. That's kind of nice. Then you have a sweet spot that actually goes, well, pretty close to $14, because you bought one and you sold two, and then the place where this trade starts getting in trouble is only once you get above 14, because you sold two options, which means that one of them is naked, is a marginable option where you lose $12.50 per tick for any move above 1401.9. Let's call it 1402. Okay, so now that is a profitability range from 0 to call it $14, and the market is at $13.20. Somebody who looks at this trade and is bullish but not extraordinarily and wildly bullish might look at a trade like this and try to take advantage of the volatility premium. So if somebody said, well, I think this trade looks pretty good, making money from 0 to 14 on intrinsic value, that looks pretty good. So now we'll demo the answer to your question. We'll save trade under tab. Oh, we got bullish soybean trades right here. We're going to go ahead and save that trade. And sure enough, in our tab, there's our trade. And then if somebody says, you know what, I think this is a good trade, let me try all kinds of other things. So somebody else says, you know what, I think this is good, but I'm going to try to do something a little bit different. So let's say that person says, let me do a 2x7. And these choices are legitimate choices. I'm just doing it for demonstration purposes, because the outcome is that you can very quickly just hit a button, change a couple of numbers, and for comparison purposes say, oh, look at this, timeout. Let me see where my profits are. Okay, so it's capped at 31.60 for profit. Okay, but above 13.90 it starts losing pretty significantly. You go 340, 13.95, because you have 5 naked options. So if somebody's pretty confident that that 13.60 is going to hold, that turns out still to be a pretty sweet spot on that trade. If the market overshoots by 35 cents, by 20 cents, 25 cents, you're still okay. And of course, you can always offset and adjust as you go. The big perk on this trade, which I want you to notice, is that if the market tanks or stays flat, the net credit on the trade can be a profit. So in fact, if somebody were neutral bearish soybeans and thought, well, maybe there's a little chance it's going to go up to 1360, maybe 1370, but no way it goes above there, and maybe it can tank a lot, a person can take this trade, which is actually a bearish, neutral, slightly bullish trade. It's all those things, and now you've got a range, which is why we call it the option ranger. Again, not recommending the trade, but just looking at the hypothetical range where the market can make a pretty significant move, a half-decent move up. We're talking about over 65 cents going up, an extraordinarily sweet spot in between on a small rally to 1350, 1360, 1370, even at 1330, which is a few pennies up from where we are, the trade would net 1460, 4160, and again, if the market stays flat or tanks, the trade is a net credit from the beginning and can make this kind of money. Now, this would not necessarily, with this new configuration, be defined as a bullish soybean trade. So you might either have to rename the tab or create a new tab if you want to be that organized. So, but in any event, it's just a way of showing you how quickly these trades can move, and in fact, I will do just that. We looked at this trade, and we decided, we need to make a new tab for this because this is very interesting, and we want to explore some more possibilities with a large credit and a range. So let's say in this case, I would call it volatility premium plays, or you can call it whatever you want, that's most easily going to remind you of your objective in this trade. And then what we would do is go ahead, save that particular trade under a tab. It would be volatility premium plays, and you can add the word soybeans there if you want. And probably that's what we will do in a more organized manner, but this is how you do things on the fly. And then all of a sudden you can take this trade and noodle around with it any way you want. You say, you know what, I want to give myself a little more room. Let me make this a 3x7. I think I'm actually getting to a trade I like, but that's my own opinion. I could be wrong. So let's just see where it goes, ends up. And again, these are May soybean calls. Now, as you can see, by doing a 3x7, your net credit is smaller. So if the market is flat or it drops, instead of that nice 3,000 plus, you're only looking at 1275. That's what you get paid in the beginning. But you have a margin of error. Instead of getting to about 1385, now you get to 1395 plus, and you still have a bit of a profit potential in there because of the initial credit collected. That's a move of 65 cents away intrinsically. And obviously, if the market gets anywhere near there, starts getting to 1360, 1370, and you have some additional naked options, you would be in touch with your broker, you would be back on your software, you would be back modeling to see whether or not you need to make an adjustment on the trade or offset the trade. But for somebody to turn around and say, I'm going to make, I think the market's going to end up between 0 and 395 and 1395 with kind of a favored range in the 1350, 1360, 1370, 1340 area, this would be a trade that you could arrive to by just inputting different numbers, going back and forth until your best numbers, your biggest numbers are in your sweet spot, and your worst numbers, the numbers that concern you, are far away. Clearly, if you thought that this market could gap overnight and go to 14 or 1420 or 1450, you would be changing this trade around to have fewer options written and to give yourself a larger amount of breathing room on an upside move. So the tabs are a terrific tool if you follow anybody. If you have your own trades, 3 weeks ago we had a couple of our clients, a prospect also come in with some wonderful trades who are in our beta group, and we were just modeling out and saying all the, giving all the disclosures about the trades being for illustration only as they were. But I'm very happy to receive suggestions from people because sometimes we end up looking at markets and at combinations that don't occur to us. The combinations are nearly infinite of creating different types of positions, having different ranges of possibility and profitability. So by adjusting position size, adjusting volatility outlook, instead of having a one-shot game, a one-move game, where we say the market's going to go up or it's going to go down, now we can make some pretty fine-tuned decisions. And again, in this example, I'm not recommending it. I'm just saying, as you can see, it's a very different scenario to say, I think this market is either going to go down or it's going to stay flat or it's only going to go up another 75 cents and still be able to make money. That is not your average trade outlook. That is a different way of looking at a trade, and the calculations that can be done here on different positions and different combinations make it easy for us to see with our eyes what is not always easy to see with the imagination. So again, I actually think we found a couple of very interesting trades today in the course of doing this, and we would love to hear other trades. If you're trading for yourself, you can set up your own tabs. You can have us set up your tabs so your trades are saved, and also so that we can monitor your inputs. If you have any questions, if you think you input something wrong, we can always log on with your permission and make sure that all your inputs and numbers are correct. The system self-corrects pretty well, so if you try to do if you forget to do something, let's say for instance you forget to input your cost, which is important in doing business. It's not maybe such a huge, it is a factor, but not necessarily as big a factor with leverage. Nonetheless, as you can see, if you make an entry that misses something, you get an error message and you are reminded to make the correction. So in this particular case, now you can do the calculation. And also, if some of your strike price or premium inputs are an issue, we can help them. You have the dialog boxes here. But again, the ultimate answer is that the spreadsheet and the output is going to have to look right. So when the output looks right, the input is right, and again, you can contact us for support. You are part of our beta group, and we love compliments, but what we really appreciate is people finding bugs in our system. We've already had them professionally tested, not by the people who set up the Affordable Healthcare System. We have our own testing people, and so I think we found most of our bugs, but anybody who finds anything in terms of error, or have suggestions on additional strategies or features, please let us know. That's why you're in our beta group. Any other questions?
No, not today.
Okay, thank you all for attending. I hope you picked up a lot. The most important thing is that you log in, you learn to play with your calculator, you learn to work with some of the inputs, and keep working at it until you find the trades that are in your range of reward and are within your parameters of risk. Thanks again for attending. We look forward to all your feedback. We're going to be doing a program on Thursday on doing short strangles, on writing premium. A lot of people are very intrigued with selling premium, with collecting premium. This is especially true of people that over the years have lost money buying options, getting clobbered by time erosion, being in trades that went in the right direction and yet still managed to lose money. So our discussion on Thursday is going to be on writing premium, on short options. For those of you that haven't seen them, please ask to view our videos on writing calls, writing puts, as well as our program that was dedicated to volatility, because that's a volatility-based approach. You can attend whether or not you see those webinars, but seeing them will give you a good foundation and make it easier for you to understand the concepts and take advantage. And thank you again for attending, and have a spectacular afternoon.
Thank you, Mr. Mueller. Mute. Are you sure? Yes. Okay, let's see if we can exit this in a more smooth fashion.